The year is 2000. The Nasdaq crashes 78%. Fortunes vanish overnight. 25 years later, people are asking, is AI the new dot-com bubble? In this video, we'll look at what actually happened during the dot-com crash, which sectors survived, which fell the most, and also the crucial lessons that could protect your portfolio if today's AI boom turns into tomorrow's bust. By the end, you'll know how to position yourself whether AI stocks keep soaring or whether they start to crash. The dot-com bubble burst between 2000 and 2002, and this followed a huge rally over the course of a year, and then the Nasdaq Total Return Index, which you can see here, fell by 83%, and it didn't recover its previous high for 15 years. Investors were caught up in the internet euphoria. Companies with no revenue or profit traded at astronomical valuations. Many people believed that the internet guaranteed growth forever. But when interest rates rose and profits failed to appear, the market corrected brutally. Here you can see some of the casualties during this turbulent period. Yet, and this is key, some investors did survive and some sectors quietly outperformed. And that's where the real lessons lie. I'd say there are three core lessons we can learn from the dot-com crisis. Back then, companies were valued on potential, not performance. Many had no clear path to profitability. Successful investors learned to focus on cash flow, sustainable business models, and competitive advantage. Here are some of the things you should look out for when investing in companies. For example, you might choose to keep an eye out for too much debt, but also strong earnings growth. The good news today is that leading AI firms do have stronger fundamentals. OpenAI expects around $10 billion in annual recurring revenue, and that's by mid-2025. Anthropic's revenue has jumped from $100 million to $4.5 billion over the space of 2 years. But valuations still matter. Even great businesses can be terrible investments if you pay the wrong price. I think another lesson is to avoid herd mentality. Now, during the dot-com mania, everybody crowded into tech stocks, and here you can see the tech sector made up almost 40% of the US stock market. In other words, diversification disappeared. When the bubble burst, concentrated portfolios were decimated. The problem was that everyone crowded into one trade, and they followed the herd. When sentiment reversed, everyone got out of the same trade at the same time, sending prices plummeting. The investors who diversified across sectors, but also geographies, lost far less. Now, the final lesson is about patience. Many internet pioneers were right about the long-term potential, just wrong about the timing. I think David Bowie captured the excitement around that transformative potential of the internet absolutely perfectly.
I don't think we've even seen the tip of the iceberg. I think the potential of what the internet is going to do to society, both good and bad, is unimaginable. I think we're actually on the cusp of something exhilarating and terrifying. I'm talking about the actual context, and the state of content is going to be so different to anything that we can really envisage at the moment, where the interplay between the user and the provider will be so in simpatico. It's going to crush our ideas of what mediums are all about.
Now, that turned out to be very prescient and quite accurate, but sustainable growth takes years, not quarters. The same applies to today. The technology is transformative, but adoption is going to unfold over decades, and that's not going to happen over the space of months. So who actually won during the dot-com crash? 5 groups stood out. First, value stocks. Here you can see the Nasdaq tracker QQQ, which has a high concentration of growth stocks. These are the shares of companies expected to increase their earnings, but also their revenues faster than the overall market. And of course, tech stocks would fall into that category. Investors who rotated into the opposite style of investing, value, avoided the carnage. Value stocks are shares of companies that appear undervalued relative to their fundamentals, and that could be their earnings or their book value. Second, defensive sectors. It was the tech sector that was the epicenter of the carnage, and any sector other than tech provided a degree of stability. Consumer staples held up well because even in a crisis, people have to buy staples provided by companies like Walmart, Campbell's Soup, and Colgate-Palmolive. Other defensive sectors would be healthcare and utilities, but materials and financials also held up relatively well in this crisis. Now, during the dot-com crash, you might expect another defensive sector, that's utilities, to hold up. But it didn't. The collapse of Enron in 2001 sparked panic across the entire energy sector. And that revealed just how much leverage and off-balance sheet risk some utility companies had taken. Rising interest rates at the start of the decade made their dividend yields less attractive. And this is a good reminder that every crisis has its own weak spot. The early 2000s exposed accounting and credit risk in utilities, 2008 revealed leverage in the financial system, and 2020 tested supply chains and pandemic resilience. What's defensive in one recession isn't always safe in the next. Third, gold climbed from $250 an ounce in 2000 to over $1,900 an ounce by 2011. Mining stocks like Newmont and Barrick Gold more than doubled during the equity bear market. When investors fled risk, real assets benefited, and that's particularly true of safe haven investments like gold. Fourth, international markets. The crash was mainly a US tech phenomenon. European and Asian markets, and especially emerging markets like China, outperformed the US throughout the 2000s. Once again, diversification across borders paid off. Finally, one of my favorite investments, bonds. Now, these provided a safe haven as investors ran away from risk towards treasuries. And then later on, yields fell sharply as growth slowed, and that also supported bond prices. Notice that longer duration treasury funds rallied more than shorter duration treasury funds, albeit with higher volatility. Now let's bring this forward to today's AI boom. AI-related stocks have driven a huge proportion of the US stock market's gains over the period since 2012. The returns of the Mag 7 were almost 3 times those of the remaining stocks in the S&P 500. The Magnificent 7 now represent about a third of the S&P 500's market capitalization. Now, some analysts claim that this AI bubble could be 17 times larger than the dot-com bubble and 4 times bigger than the subprime bubble. So if we did see an AI reversal, history suggests that certain patterns would be likely to repeat. Value stocks could outperform expensive growth names. Defensive sectors like utilities and healthcare, consumer staples might offer shelter. International and emerging markets could outperform if US tech falls. Commodities and gold might shine again as investors seek safety. And bonds could rally if central banks respond with rate cuts. In short, the winners during the dot-com collapse could once again lead the pack if AI enthusiasm fades. But we shouldn't assume that history will repeat exactly. There are important differences this time. Firstly, stronger fundamentals. AI leaders like Microsoft, Nvidia, and OpenAI actually have robust revenue and profits. The Mag 7 make up about a third of the S&P's market capitalization and a quarter of its forward earnings and an eighth of its forward revenues. In other words, for every dollar of profit generated by companies in the S&P 500, roughly 23 cents of that dollar come from just these 7 firms. Their market share and profitability have surged since 2020, and this simply highlights how investor enthusiasm, but also margins, have become increasingly concentrated in just a handful of mega-cap tech companies. If we dig into profit margins, the Mag 7 really stand out, I think. Their average forward profit margin is about 27%, and that's more than double the 12% margin for the rest of the S&P 500. In other words, these mega-cap tech companies are just far more efficient at turning top-line revenue into bottom-line profit relative to the remaining 493 companies in the S&P 500. Now, if we look at the income statement for Nvidia, you can see just how extraordinary its profitability has become. Out of $130 billion in revenue, an incredible $81 billion flows through into operating profit. Now that's an operating margin of 62%. That's not just high, it's almost unheard of for a company of this size. And this highlights Nvidia's dominance in the AI chip market and its ability to turn booming demand directly into profit. There's also better capitalization. These firms are sitting on mountains of cash, not burning it as dot-com companies did. And you can see that here illustrated for Nvidia. There's also a different policy backdrop for monetary policy. The Federal Reserve is easing now, which means that it's lowering interest rates, not raising them or tightening as it was in 2000. And we mustn't forget the infrastructure value. Even if some AI companies fail, the data centers, chips, and software they've built will retain value. So while valuations are stretched, the foundation underneath is much more substantial than it was in 1999. That doesn't mean there won't be corrections, of course there will, just that the outcome could be more of a rotation than a total collapse. If all this talk about bubbles and crashes leaves you wondering how to protect your portfolio, that's exactly what our PensionCraft Premium website membership is for. When markets become volatile, like they might if the AI boom deflates, having a trusted source of insight and support makes all the difference. Inside our community, you can ask questions anytime you like in our member chat app, but also get thoughtful answers from over 1,000 like-minded investors. We also provide video explainers and interactive tools, including our tracker apps. Now, these help you understand what's happening in the economy, but also how it affects your investments. For example, our Gilt Ladder tracker helps you map out your future income precisely, and that can bring real peace of mind when markets are turbulent. So whether you're growing your investments, managing drawdown, planning retirement, or just trying to stay disciplined through the next market shock, our community members tell us that it helps them invest with less stress, but also more conviction. At PensionCraft, it's all about confidence, clarity, and community. Just go to pensioncraft.com/membership to learn more, or look at the link in the description below. In summary then, I think the dot-com crash taught us some really critical lessons. The first one is probably to focus on fundamentals. Things like profitability, earnings growth, not having too much leverage, all of those are really important. Another point is that you should stay diversified. You should always be humble and admit you might be wrong. Of course, AI is very transformative, but if you overpay for it, that can be a problem. Part of that is to avoid herd behavior. Just don't do what everybody else is doing, because when the correction comes, it might be quite brutal. And then finally, I'd say keep a really long-term perspective, because you always get these booms and crashes, but really what matters is that long-term upward trend for equity. The overall lesson is pretty simple. Stay diversified, stay disciplined, and just don't get swept up in the AI hype. So if you did enjoy that video, you found it helpful, please tell us in the comments and like and subscribe. And don't forget that if you wanted to join our membership, you can do that on our website, pensioncraft.com/membership. And as always, thank you for listening.